The World Bank has raised its crude oil forecast for 2017 to an average of $55 a barrel. That's actually $2 higher than its prior forecast in its latest Commodity Markets Outlook report. Now, energy prices as a whole, those are forecast to rise by almost a quarter overall next year. Agricultural products and metals will grow at a steady but far less dramatic pace.
Low commodity prices have, of course, hit oil producers hard over the last couple of years. But the World Bank says it looks like we're no longer scraping the bottom of the barrel. It's forecasting an average $43 a barrel for this year, with a $12 jump for 2017 to $53 a barrel. The Organisation of the Petroleum Exporting Countries is looking to reach a deal during a meeting in late November to constrain production in order to try to increase prices, which may include non-OPEC members like Russia.
So there are a lot of question marks as to whether what's going to happen with the countries that are not included in the agreement, the OPEC countries that are not included in the agreement, what's going to happen with Russia, and what kind of freeze or reduction they are going to agree at the end of the day.
Under the deal, OPEC members Nigeria, Libya and Iran would not be subject to constraints in order to take into account previous production losses owing to security problems and due to sanctions in the case of Iran. Also, non-OPEC countries not willing to make a deal would have the ability to raise production quickly to take advantage of any price rises, particularly US shale oil producers.
The shale oil industry needs only 1 day of high oil prices. They don't need high oil price for 3 years. They need high oil price for 1 day, they can hedge it, and then they can produce for the next 3 years, regardless of what the market price of oil is.
The World Bank sees the continued pattern of slower global growth as providing a strong headwind to oil price rises. But the World Bank identifies two major risk factors that may push prices higher: instability in the Middle East and economic vulnerabilities that may limit Venezuela's ability to maintain production. Daniel Wrenches, CCTV, Washington.
And he joins us now once again from Washington, D.C. Daniel, this report is fairly interesting, but the report authors did admit there's a lot of uncertainty around the nature and the size of any output reduction deal being arrived at by OPEC. So why then did they decide to raise the price forecast for next year?
I think it comes down to a general judgment that there is likely to be some kind of OPEC deal on the table, and that will move the needle a little bit towards the positive on the oil price, that there will be some output production cuts somewhere along the line that will trickle through to being a supply constraint, and therefore we'll see a slight dip. But I think, the bigger picture here is a global economy that is beginning to recover in the eyes of the World Bank and the IMF, and that recovery will be a little bit stronger in 2017. I think that is the main input into their forecast, frankly. It's not a huge leap on their July numbers. $2 a barrel is not huge, but I think it reflects their balance, not only of the way the economy is likely to go, but also obviously balancing out the geopolitical risks that are out there and are frankly difficult to predict.
Indeed. We'll leave it there for the time being. Thank you for that. That's Daniel Wrenches in Washington. He'll be keeping tabs, of course, on developments right across the commodity market for us on the program.